Well, good morning. And first of all, thank you to ETF Global very, very much for bringing us all together to listen to some very insightful conversations and learn about the ETF market. I'm Mariana Fariña, and I spent over 30 years at Wells Fargo doing research and conducting due diligence on ETFs and closed-end funds. And I will ask this wonderful panel, I will ask them to introduce themselves, tell us about their name, where they work, and what the firm does a little bit. And let's do it in alphabetical order of last name. So Marissa, let's start with you.
Yes, that's me. Does this work?
Yes.
Fabulous. Good morning, everyone. So excited to be here. Thanks very much for taking the time. I'm Marissa Ansel. I head up ETF investment strategy at Goldman Sachs Asset Management. Goldman Sachs Asset Management is the primary investing arm of Goldman Sachs. We manage assets on behalf of clients globally across all different asset classes, institutional clients, advisors, and also private clients. I've been at the firm for just over 20 years, actually coming up to 21 years. I spent my first 13 years at the firm in London, which is where I'm from. You can probably tell by the accent. And then I've spent the last almost 8 years here in New York. We run almost 60 ETFs, totaling about $42 billion in assets. And I have the privilege of running our ETF investment strategy efforts globally.
Thank you, Marissa. Marcel, how about you?
Good morning. My name is Marcel Benjamin. I work for State Street Global Advisors and the Spider family of ETFs. I'm a senior fixed income strategist, so I support the distribution of our fixed income ETFs. I was pleased to hear a couple of tickers mentioned on the previous panel. I'm sure everyone's heard of GLD, and one of the sector funds was mentioned, XLE, so we're famous for our sectors. SPY, of course, MDY. But we actually have a really robust fixed income ETF lineup. We've got 165 billion across US bond ETFs, 55 funds in total. And I'm kind of the resident bond geek, so I'm going to approach this panel through the lens of fixed income.
Great. Thank you, Marcel. And Greg?
Hello, everyone. Good morning. Thank you for coming. My name is Greg Bihar. I'm head of solutions at Westwood Investment Group. Westwood was founded 40 plus years ago by Susan Byrne, really on the fundamental active side, but we have several boutiques. We have energy and real assets. We have equities, multi-assets. My team is the solutions team, and we really focus on outcome-oriented solutions. We believe it's all active, design matters, and we focus on that construction and methodology. So think of direct indexing, tax gain loss management factors, ESG, etc. In terms of ETFs, my team just launched Be Free. So BFRE is the ticker. So that's giving you global equity exposure, but reducing that authoritarian regime risk. So it's tilting towards freedom, and I'll talk more about that. We also have our partnership with Web. So similarly, actively designed, rules-based, transparent framework there, and that's looking at giving you exposure to things like the NASDAQ and S&P, but defining that volatility, so giving you a smoother path by dynamically weighting there and giving you looking to improve risk-adjusted returns. And then on the fundamental active side of things, we have our energy ETFs, and that really is giving you exposure to broad energy as well as midstream, but active selection there, and then enhancing the yield through options there. So they have a decades long experience in the energy space. I'd say we have the spectrum, and we'll talk about this, of that active design, rules-based implementation, and that fundamental active ETFs.
Thank you, Greg. And last but certainly not least, Rafael, with a last name that starts with a Z.
It's A to Z. Hello, my name is Rafael Zayas. I head up portfolio management trading for Vidant Asset Management. We work with a lot of ETF issuers to help them design, launch and then manage ETFs. My reason for being here is we work with a lot of active managers, some of which are in this room, to help them through issues of thinking through portfolio implementation concerns, capital markets, and how the ETF wrapper impacts investment strategies. And so I'm happy to be here to talk about it. Thank you.
Great. Thank you. Wonderful panel. I'm excited not only because the topic of this panel is very interesting, active ETFs, but also because hopefully, well, of course, hopefully you will learn a lot, but it will also nudge you to listen and participate on other panels later in the day that will discuss more in depth what these panelists will mention. And what the big topics that we're going to be discussing here are kind of the framework of active. Where should one spend active dollars? Then discuss the idea that active is not black and white. We'll talk about that. Some of the challenges of active ETFs for a number of parties, not only the managers, the ETF ecosystem, but also the investors. And finally, we'll kind of talk a little bit about, so what's next, what's coming next, or what's happening right now and what's coming next. So with that, let's start with the framework in terms of not just why active, that's a little bit kind of basic, but why active, but where should we spend active dollars? And with that, Marissa, why don't you start us with that?
Sure, happy to. So active management, I mean, I think, historically active has really, and I've been actually in active management my entire career, so 21 years and a little bit more. I think active management historically, was the preserve of, institutional investors. Really, when I started, probably most of us here started in the industry, you could only really access active management via mutual funds or separately managed accounts, right? So active ETFs didn't exist. What we found over the last couple of decades is that ETFs have absolutely exploded in popularity, and rightly so, because they offer, of course, the tax efficiency, they offer the transparency, the ease of trading, often the lower fees versus the other vehicles that I just mentioned. But what we're seeing now is a huge explosion in active ETFs. And why is that? I think that's because they really bring together the best of both worlds. They combine the benefits of active management with the benefits of the ETF wrapper that I just mentioned. And so to me, active ETFs are really democratizing access to active management capabilities, which again, as I mentioned, historically have been the preserve of, the world's largest and most sophisticated institutional investors. And now everyone can get access to the world's leading active management capabilities. It's interesting if we look at the stats though, active ETFs represent only 9% of overall ETF assets, and yet they've represented 39% of flows into ETFs year to date, and they've represented 88% of new launches year to date. And so clearly we can see, where the train is going. And I think, again, that's for good reason. But why do people go active? People go active because they're seeking to get something over and above the benchmark return, right? They don't just want the market return. Passive inherently always underperforms because you get the market return minus fees. And so when investors choose to go active, it's because they want to get something more. They either want to get the benchmark plus some alpha, or they want to get a different return profile. However, there's no such thing as a free lunch. And so as you guys will know, active ETFs are more expensive than passive, right? So the average active ETF costs 43 basis points. The average passive ETF is about 12. Obviously, there's a very wide range within that for on both sides. And so, I would just say that I think investors need to spend those active dollars really wisely. I think you need to be smart around how and where you put those active dollars to work. To me, I think there are two main areas that it makes sense to go active. This is very broad brush. Number one, I would say in less efficient markets or in less efficient parts of the market. So small cap could be a great example here. Small cap is inherently much more inefficient than the large cap space. You have on average 6 sell-side analysts covering each small cap stock versus 20 something in the large cap space. So you've got a lot more inefficiencies. And that means there's a lot greater potential if you pick the right stocks to generate alpha and outperform the market. And if you look at the small cap benchmark, if I look at the Russell 2000 as an example, you've got 27% of companies that are actually still loss-making. So you definitely don't want to buy the whole benchmark in the small cap space. So you want to pick a manager, you want to go active, you want to pick a manager that knows small cap companies, has a lot of experience investing in that space, has demonstrated, success, and can be really selective around the stocks that you buy. And actually, when we look at the stats, this is why 81% of small cap managers have over the last 5 years outperformed their benchmark, versus in the large cap space, it's about 20-something%. So that's why. The second area that I would say, it makes sense to kind of spend those active dollars is if you're looking at a product that gives you a different solution to just, outperforming the market. And so an example here would be something like if you're looking for income. So if you're looking at, let's say, a derivative income ETF that's actually is designed to give you a steady, consistent stream of income. Or if you're looking for a defined outcome, so like a buffer ETF, for example, where you want that equity exposure, but you also want to kind of hedge yourself to the downside and have some of that downside protection. So those would be sort of two main areas where I think it makes sense to kind of spend those active dollars. And the last thing I would say is just now is really the time to go active. If you look at the US large cap market, you've got almost a third of the S&P in 10 stocks. You guys will all know those stats. So going passive, you're running a lot of concentration risk. And so active is another way to add diversification to portfolios. And one thing that we can all agree on right now is there is a lot of uncertainty in the market. I don't think that's going away anytime soon. And so uncertainty is a gift for active managers. Uncertainty creates volatility, it creates stock level and security level differentiation. And this is exactly what active managers want, because the good ones can use that to their advantage.
Thank you, Marissa, and thank you for mentioning some of the statistics that you did a moment ago. The ETF rule back in 2019 probably certainly had an effect on what we're seeing in the statistics that you mentioned.
Can
and
I
Marcel,
just, yeah,
yes,
I just wanted to add,
the
those
fixed
were great
income.
stats. I think you said 9% of all ETFs are active. Was that the number? Yeah. So looking at it through the fixed income lens, and we didn't study for this exam together, but it seems like we studied the same stuff. So there's about, I have a spreadsheet with all the bond ETFs in the US, and I look at it every day. That's my job. So there's about 1.95 trillion of US bond ETFs currently. We're probably going to hit 2 trillion in a month or two. 350 billion is an active fixed income ETF, so 18% AUM share. But the other interesting number that you cited was the flow share year to date. And what was that? Do you recall?
39% of flows, 88% of launches.
38% in fixed income of inflows into fixed income ETFs this year have been into active. So more than double the AUM share. So I think those are really important stats.
For the fixed income, I feel like there's been a lot fewer launches and a lot less diversity of strategies, of active strategy in the fixed income space compared to equities. Do you think that trend, you're seeing changes in that trend?
Yeah, I think there's been more innovation. The 350 billion is across over 400 funds. But, the market does tend to be top heavy. And if you start to break out the AUM, there's many fewer funds just over $1 billion, obviously. So there's a long tail of small funds. But the innovation hasn't stopped by any means. And we'll talk about some of that later.
And I really love the statistics on both sides, and thank you for the fixed income perspective, Marcel. Now let's talk a little bit more thoughtfully about active. What is really active? Too many people, unfortunately, think that it's a black and white thing. It's either passive or active. The truth is it's a spectrum. There's a lot of gray in between. So Greg, you're going to tell us about, and you already mentioned a ticker, and you tell us more about that.
Yeah, well, I'll take a step back first and just say, what I said earlier. My team, we believe, that there's no such thing as passive, right? That it's all active, and that all of these strategies should be evaluated in the same way. You have to understand the design, construction, methodology, philosophy, and process before you invest in an ETF. And so perhaps there is a spectrum. On the left-hand side is your traditional market cap weighted index strategies. To the right of that is going to be any sort of customization to that, excluding a country. In the middle is what I would say actively designed, rules-based, more quantitative, factor-based, different weighting methodologies. To the right of that may be thematic, just because a little bit more subjectiveness there, more concentrated in volatility to it. And then to the right there is your fundamental active ETFs. And perhaps there's a fee spectrum to that. It might get more expensive. It may get more sophisticated. You may see less transparency, higher transaction costs. Those are some of the things that we would see on the spectrum there. You're wondering, how do I say market cap weighted is active? And so inherently price times shares, that's market cap weighted, right? And you get factor biases from that. You get sector biases from that. You get country biases from that. We know the S&P 500 is heavily concentrated in tech, the Mag 7. There is different country rules. FTSE says Korea is developed. MSCI says Korea is emerging markets. You're going to get different results from that. There's different inclusion criteria. We just talked about small cap. Russell 2000, S&P 600, 98% correlated over 10 years, but the S&P 600 requires 4 quarters of positive earnings. The Russell 2000, 40% of the names are non-earners. So S&P 600 inherently has improved risk-adjusted returns. To the right of that is the customization I'm talking about, and there's a very popular ETF that removes China. There's lots of concerns now. First it was Russia, then China. Well, what are the unintended consequences of removing China just simply from an ETF? You just remove it from the index, and now you have more India. You also have more Korea and Taiwan. So you have more exposure to Asian countries that have a high correlation, a high beta, high supply chain, high revenue to China. So did you really mitigate your China risk? If you look more closely, you'll see that you're overweight other authoritarian regimes, right? So what's the next shoe to drop? We see some issues recently with Turkey as an example. And the real focus, we think, is on that indirect risk to China and these other authoritarian regimes. So think of it like an iceberg. You see above the water the exposure to these countries like Russia and China and Turkey, right? But below the waterline is your indirect risk to those countries. So look what happened when Russia shut its doors. The stock fell there, then your assets were frozen. But McDonald's also fell in sympathy with Russia because they had to write off $1.5 billion and sell their stores there for $1. And so that affected that stock. Nike more recently, look at Nike with the tariffs, the extreme tariffs on China. Obviously, Nike has supply chain issues there with China that affects those stocks. So the focus, we believe, really needs to be on that indirect as well as that direct risk. And that's where the middle area that I'm talking about, a more thoughtfully designed, actively designed, but rules-based and transparent implementation, where with Be Free, we're giving global equity market risk premium, but with a 70% reduction in both that direct, indirect, authoritarian exposure. And there's academic evidence showing that tilting towards freedom enhances economic growth. So we see better risk-adjusted returns, and we don't see that you're compensated for that authoritarian risk. And that sits right there in the middle of that actively designed, rules-based, and transparent framework.
If there is one thought that you should take away from this panel is definitely look under the hood. Sure, you can look at expense ratio, but do that last. Just make sure that you understand all these differences that are really going to be a much, much bigger impact than the differential and the expense ratio show. Pay attention. Marcel, you wanted to add something?
Yeah, I
as
think,
well?
you know, on the fixed income side, active can mean a lot of different things. So if you take the top 3 categories in the fixed income ETF landscape, the largest one is what I'll call ag or multi-sector. And those strategies often benchmark to the ag or the universal index. If you're not familiar with that, look it up. It's the ag plus some high yield. And they typically have a core bond exposure, and then they allocate to satellite income types sectors like high yield, emerging market debt, bank loans. And you want to be mindful of the risks. You know, if you're an active high yield manager, for example, and you have a strategic allocation to equities, then you're probably going to beat your high yield benchmark. But now you're taking equity risk. So when you're in one of these multi-asset exposures in fixed income, understand what's under the hood. Active is typically taking a little bit more risk, whether it's credit risk, duration risk, complexity risk, and hopefully beating that benchmark. If I look at the second category, that's the largest, second largest in fixed income ETFs, it's ultra short. And that's really an exposure that's maybe one step beyond a substitute for prime money market funds. These are portfolios that tend to have maybe half of the portfolio maturing within 1 year, and they've become a substitute for money market funds. They have a little bit more risk for certain, but you know, they typically don't have below investment grade securities. They typically don't have a lot of duration risk, and the performance differential is very muted, but there isn't any real benchmark. And that's one of the main reasons for why that category is so large, is because there isn't really an index that you can use in that space. And then the third largest category is bank loans and CLOs. So we have a bank loan ETF, bank loans, leverage loans, senior loans. Our ticker is SRLN, or we call it Sirloin. It's the largest loan ETF. It's actively managed. It's sub-advised by Blackstone. And if you look under the hood and you compare it to the index peer, the index is the 100 largest loans in the market. And this fund plays in the 350 largest loans in the market. And both funds have a little bit of high yield exposure for liquidity purposes, but they're not buying mortgages. They're not buying other asset classes like emerging market debt. It's really purely batting singles around the loan index and being thoughtful around that. And I think that means a very different thing. Active management in the loan space means something very different than active management in the ag space. The other thing about an exposure like SRLN is that this tends to be a relatively high fee category. And so the return stream from an ETF is going to be, for an index ETF, should be index less fees, index return less fees. If you have an active fund in that category and it's able to outperform that benchmark, you're actually getting a return stream that's closer to the benchmark. So we had a lot of conversations with clients who say, I don't want active, like, you know, I want the index. Wouldn't you rather have a return stream that looks more like the index, even though it is an active fund, than just get lower performance through this index ETF? And that's a different way to frame the conversation about active versus passive, is really looking at the returns and comparing them to the benchmark and realizing that active can just eat back some of those fees and get you the performance that you actually want.
Thank you. And if I may just add one thing, I think, so I agree with Greg and Marcel's comments around, you know, active really being, it's a scale, right? It's not a binary thing. So you've got a whole scale of actively managed products. I think one thing that's interesting though is now we're actually seeing, you know, what I'll call hybrid active passive products. And you know, a good example of this would be our derivative income ETFs, the tickers are GPIX and GPIQ, where we have deliberately designed them to really harness the best of both worlds in terms of active and passive. And so our underlying equity exposure, S&P 500, NASDAQ 100, right? So that's passive because we want our clients to, you know what they're getting with the equity component. But we manage an active call writing overlay on top. And the call writing overlay, we can adjust very dynamically. We don't cover the entire portfolio. We adjust it according to the market environment, which means that we allow a good portion of the portfolio uncovered and able to participate in market upside. And so that's kind of it's sort of an interesting example of where I think the industry is going. It's not just active or passive. Now you're starting to see the emergence of products which kind of combine the best of both worlds. And actually maybe one other example would be our buffer ETFs that we just launched earlier this year. It's a suite of 3 buffer ETFs, GBX A, B, C. And again, we very deliberately, went passive with the underlying equity exposure. So it's S&P 500 exposure. That's pretty much what, a lot of our clients are asking for. But again, we have an active options overlay, which we use to provide, in fact, not just one, but two downside buffers. So, clients really like kind of knowing what they get, but at the same time, they're getting that protection as well.
So it could be passive and active both inside the same ETF.
Yeah, exactly.
Rafael, is there anything that you want to?
Yeah, I was just going to say that I think what's interesting about the way that the active ETF space has evolved compared to the mutual fund space is that we're seeing, I think, an interesting breadth and diversification of strategies. So we're talking about derivative strategies, right? Those have been around in the mutual fund space for a while, but I think they're really taking off in the ETF space right now because I think that the investor base is quite different. And so there's a couple of reasons for that. One, I think, is that there's a lot more retail ETF buyers than I think they play a more outsized role in the ETF landscape than they do perhaps in the mutual fund landscape. And so what we're seeing are a set of strategies that may not have been as successful in the mutual fund wrapper. And I think that's interesting, and it provides a lot of different exposures for ETF clients and different active strategies.
And if we haven't convinced you, there's a lot. It's not a black and white. I do remember back talking about fixed income back in 2008, the high yield ones where there was not a lot of liquidity. There was so much active choosing and selecting the bonds behind the scenes, even though it's supposed to be a passive. And I would argue one more thing, that even to Greg's point, to the far left, I think, extreme that you were talking about, truly passive, even if we think about an ETF that is passively managed, market cap weighted, okay, you can't get really much more passive than that, right? You may still also have securities lending that is an active element, and hopefully also reduces the expense ratio. But we noticed that even ETFs from different sponsors that track exactly the same index, we adjust for expenses, there was still the securities lending that made a little bit of a difference. So hopefully we've convinced you that it's not a black and white issue, the active. And there's a lot of active inside passive as well, more than you think, for the good. Okay, so moving on to maybe a few challenges. And let's start challenges of maybe an avalanche of ETFs for the active ETFs for the managers. Rafael, would you like to talk about that?
Yeah, sure. So as on the investor track, I don't know how much this audience is aware of a lot of things that are being discussed on the industry track upstairs, but the growth of actively managed ETFs we expect some acceleration due to regulatory changes that allow mutual funds to offer ETF share classes. And so that is potentially a very big shift and is going to potentially create a lot of new active ETFs that don't exist now. And so what I wanted to spend a moment just talking about is what is the impact on the actively managed ETF ecosystem on all these new entrants. And so there's a couple of things. One is that distribution platforms are going to have likely going to have a stronger grip on the ETF options on your menu for investors than they have in the past, because there's already so many ETFs, and the power of some of these distribution platforms to effectively gatekeep some strategies, they're going to have more opportunity to wield that power and to earn revenue from that. And so that's something that I think people should be cognizant of, is how your platform through which you invest impacts the decision. You potentially impact the decisions you make. The other key change is that I think when I'm talking to a lot of active managers, I think that there's this perception that the ETF ecosystem will innovate out of through some of the capital requirements for market making and the custom redemption process, which is what makes so many of the ETFs tax efficient. And so what I would say to that is that in practice, those activities, so ETF market making and the capital or the custom redemption process that makes ETFs tax efficient are both capital intensive activities for broker dealers. As a result of that, especially, we just heard in the previous session, an expectation that interest rates may go up, right? There's a cost of capital to all these activities. So some of what's being discussed is, can the ETF ecosystem support this level of tax efficiency, this level of tight spreads across this, wave of actively managed strategies that are coming to market? And it's not obvious that that's going to be an easy case. So I bring that up only to say that as investors, I think understanding some of the mechanics of the ETF ecosystem, maybe not, this quarter, well, it's always good, right? But in particular, as these new strategies launch, you will benefit from understanding some of these concepts and understanding how to evaluate them, knowing what it means if the bid-ask spread for certain ETFs are wider. Things like that might be a sign of, potential either capital crunch and or other issues with the product. And so understanding the ETF mechanics may help you all as part of your research of these actively managed strategies.
Thank you, Rafael. And you mentioned another panel that maybe the audience may be interested in following up. And I think that's the 1125 on the 11th floor ETF share class. Maybe that may interest you. Marcel, you wanted to?
Yeah, some of the hurdles that we've seen is, first of all, I think from folks who sit perhaps in a manager research function or, in a regulator of some sort, they can get comfort with an index exposure. One of our largest funds is a fund that buys all of the corporates issued between 1 and 10 years. So it looks at the ag, the corporate component, and then it has a maturity band between 1 and 10 years. It's a very simple exposure. It's an index that's been around for a long time, Lehman, Barclays, Bloomberg today, right? And they can get comfortable with that profile, the history, the risk there. But then you add, you open up an active perspective, the perspective of an active fund, and you look at all the different asset classes that the manager would like to potentially play in. And, these constituents, like I said, maybe someone in manager research, they're worried about the potential downside risk. And so there may be some that just, start at no active. And we do come across some of those types of constituents. And of course, you have to educate them. And some of the comments I made earlier about the loan ETF, I think are important. The other side of that is really that, again, going back to Sirloin, some of our largest holders of that fund, you can go on Bloomberg and look at the holders and pull it up, are active mutual fund managers of loan strategies using our ETF as a placeholder to fulfill some sort of liquidity rule or something like that. But the initial conversation was, no way, I have an active loan fund. No way I'm going to hold your active loan ETF in my fund. What is that going to do from, what are my investors going to say? We've overcome those hurdles because they realize that it's a better return stream. It's more aligned when they look under the hood with the exposures that they do want, that they already have in their portfolio. And so that's been a longer process as well. But those are, just some of the hurdles that we've encountered along the way with active ETFs.
It's funny, those comments remind me of a few decades back, 2002, I think, when the first fixed income ETFs were coming out. And then they started easy with just treasuries. And then they started in ag and investment grade corporates and then high yield. I remember the conversation was, oh my goodness, can that be done? We know it can be done. And so ETFs are really stretching the boundaries every time. And I know that we'll continue to stretch them.
And just to your earlier comments, there are index ETFs that, they are not active. They're not called active. But when you look at how they have to get the exposures, they cannot own every bond in their index. It is impossible. If you look at something like the muni market that is so fragmented, where there are tens of thousands of securities that are issued, it's a $7 million issue, it's a $15 million issue. There is no way to get that exposure. And so that's where sampling comes in. And I'm not going to say sampling is active, but you cannot own the whole index, and you have to pick and choose what you're going to use to represent those exposures.
You mentioned munis. How about muni high yield? There's definitely a lot of active behind it.
Yeah, I was just going to say, so we speak with a lot of active managers, and for a lot of the last few years, it's been more traditional active managers that might have mutual funds or large SMA books. That has changed quite a bit in the last year or two, where we have more hedge funds looking to see how they can launch what does a publicly listed version of their strategy look like. And so to that point of, really trying to democratize exotic strategies, I think that trend will continue for sure.
Mm-hmm. And to finish with the challenges, I'm looking at the time. How about the challenges for the investors, the financial investors, if we get so many? We're already getting, but probably get more active. Marissa, you wanted to talk about that?
Sure. Yeah. So I think, look, active ETFs, you need to do your due diligence on them in exactly the same way as you would due diligence, a mutual fund, a separately managed account, any other active strategy. The manager is really, really important, obviously, in an active strategy. So, you really need to take the time, do the research, look into kind of what you're buying. I do think that, the starting point has to be, what are you, either if you're the investor or if you're the advisor, what are your clients' investment objectives, right? So different people are looking for different things. Are you looking for capital growth? Are you looking for income? Are you looking for capital preservation? Maybe it's a combination of all of those three things. So I think you need to be clear on what your or your clients' investment objectives are. And then I think you kind of back into, the type of product that would be most, appropriate. Peter on the last panel talked to you about the 7 C's. I'm going to talk to you about the 5 P's. If you give me an extra minute, I might be able to think of another couple of P's. But to me, when you look at an active manager and you assess, their capabilities, I think there are 5 P's that you want to focus on. So number 1, the product. Number 2, the people. 3, the philosophy. 4, the process. 5, performance. And there's going to be a test at the end, so I hope you guys remembered that. No, I'm joking. So let's unpack each of those, one by one. So first of all, the product. So obviously, you want to understand the product design. Is it investing in US equities? Is it a region? Is it a single country? Maybe it's part of the market, small cap, mid cap, large cap. Maybe it's a single sector. Maybe it's a theme. Greg talked about some of the thematic products that are out there. So you want to really understand what the product is and what it's giving you exposure to. In other words, what is its investable universe? Okay, and then I think you really want to make sure that aligns with your investment objectives. I think you also want to think about the prevailing market conditions, because not every type of product is going to work in every type of market environment. So that's the first point. Second point is the people. Again, the people are really, 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 really important in any type of actively managed product, because that's really what you're buying. You're buying their ability to pick stocks or pick bonds or manage an options overlay strategy such that they can outperform the market. Okay, so you really want to look at the team. You want to look at how big they are. You want to look at how experienced they are, where they're based. I would actually say that if you're looking at products outside of the US, it's really, really important for those teams to be local and based on the ground in those in those local markets in order to be experts in those companies or bonds. So that's on the people. Number 4, did I get to 4 or am I on 3? Product, people. Number 3, philosophy. So here, different active managers have different philosophies. Some lean more growthy, some lean more value, some are a bit more core, kind of straight down the middle. So you want to understand, the philosophy of the manager that you're buying, and make sure that, again, that suits, your investment objectives. Number 4 is the process. So again, really try and dig into the process. Is it repeatable? Has that manager used the same process through different market environments? This is something that institutional clients look at really, really closely. They want to make sure that, an active manager that they're due diligencing doesn't just suddenly abandon, their principles and their philosophy and their process the minute, that the market environment gets a little tougher. You really want to make sure that you choose a manager that knows what they're doing. They have, very firm philosophy. They have a time-tested process, and that they stick to that through different market environments. And then finally, what was my final P? Told you there was going to be a
Performance?
test.
You said there was only
Excellent.
4. You're
Four.
adding
You see,
5
you're all
now.
awake. I love it. This is
Can't
great.
add 5. You said there was 4.
So 5 is performance. So again, look at the performance track record. Look at the risk as well. You know, there's obviously we all know that the compliance disclosure, you know, past performance does not guarantee future results, but it can give you a pretty good insight into what that manager has already delivered in the past in that strategy or in a similar strategy. I would say, you know, if the numbers look too good to be true, they probably are. So just be wary of that. Look also at the benchmark, because, you know, some managers, you know, that are a little naughty, not us, you know, will choose a benchmark that is not really a very fair comparison of the investable opportunity set that they're, you know, the pond they're fishing in. So look at the benchmark, make sure it's appropriate, look at the performance, and if you can, try and see where that performance has come from. Is it repeatable? Is it consistent? So those are some of the things that we look at.
Yeah.
I'm going to stop there. I'm not going to mention 7 because I was struggling with 5.
Yeah, I would just reiterate on that, on the benchmark. And we talked about small cap being an inefficient asset class. Active managers sometimes know that Russell 2000 is easier to beat because it has those 40% of the names that have non-earners, and you know you do a quality bias to it. So can they beat the S&P 600? You know, which is low cost and cheap and has that in there, right? So when you're evaluating active management, and you know, I take a more quantitative approach to it, is regressing the returns, and are they doing something beyond the betas that are out there? So is it just a quality and value bias? Because, you know, you can have that more cheaply on the spectrum, whether it's in that, you know, traditional passive market cap weighted camp or in that middle actively designed rules-based and transparent management camp. So there's going to be different fees to it. You want to make sure that there is something being done beyond the beta piece of it. So there's something unexplained when you regress those returns that is coming from that active management.
Great. So for the last few minutes that we have, onto the last prepared topic that we have. What's next?
More ETFs, more active ETFs.
What's next in terms of active ETFs? Yeah.
I
Oh,
think-
more. You're just saying more. Yeah.
I'd like to just mention a couple things there. I can't really speak about what's in our pipeline for development, but I think some of our very recent launches would be a good example of innovation. And you know, we came out with the first ETF in 1993. We are going back to our heritage of innovation. And you mentioned, my esteemed co-panelist mentioned hedge fund strategies in ETF. So we recently launched the Spider Bridgewater All-Weather ETF, ticker ALLW, giving you the strategy that Ray Dalio and his team run at Bridgewater. And that has really taken off. We've seen assets quadruple in just a couple of months. We recently launched a public and private investment grade credit ETF. So we are offering access to private credit securities in a partnership with Apollo, where they are originating those securities in an ETF wrapper. That's PRIV, and that came out a few months ago. And then we looked at the stated maturity category, which is building your own bond ladders with ETFs. And there are 2 incumbents there, and they're both index funds, index series. And we decided to go active there, because another way to think about active is just being a little bit more flexible, a little bit more mindful, a little bit more thoughtful about your exposure. We have a client counsel that came back to us and said, you know, these funds are in the market, we like them, but they have some important flaws. Can you launch something that works a little bit better? And so since we've launched those in September, we're seeing better performance, more income, and a better mousetrap for building your own bond ladders with stated maturity ETFs. So those are just a few examples. I wish I could tell you what is in the new product pipeline, but you know, that's MNPI for at least from my perspective.
Just very briefly, you talked about private, and the next panel, I think here, is going to be private market. So just a plug for that panel.
And I would add, just super quick, I think there are probably 3 things 3 themes and trends that we would see continuing. So one, so totally agree in terms of public and private coming together. I think that trend is going to continue. I think a lot of managers, ourselves included, are spending a lot of time thinking through kind of how to make that work best. for our clients. We're very fortunate. We have an amazing alts business. So really thinking through kind of how to put that private exposure, which is of course inherently illiquid, into a very liquid ETF wrapper, and kind of what that format should look like. That's number one. Number two, I talked about derivative income ETFs. They've been the biggest flow gainer by Morningstar category year to date, over the last 1 year and over the last 3 years. And I don't see demand for them, slowing down from here. And then the last thing I was just saying, kind of picking up on, I think a couple of people mentioned this, fixed income. I think you're going to see more active ETFs in the fixed income market, again, kind of democratizing access to that market. We launched about a year ago a suite of active muni ETFs, and we're seeing a lot of interest from our clients in those, again, giving access to world-class investment capabilities now in very easy format of the ETF.
The only thing that hasn't been mentioned I'd touch on is I think the ETF space is really looking at how to deploy leverage really interestingly. And so I think there's a lot of products around that I think that trend will continue.
Yeah, I was just going to say, thank you. First ETF in 93. So crazy. And you're still coming up with innovative names. I thought you said Sirline for one of them. So with the proliferation, I don't remember what it exactly did, but the name sticks with you. Proliferation of ETFs. I don't know, we're going to run out of tickers pretty soon to be able to do this, but there's certainly some white space out there, and we continue to innovate. Of course, as I mentioned, there's an ETF that excludes China. There's an ETF that looks at authoritarian regimes, but there was never one that looks at the global equity market landscape and looks at both direct and indirect exposure for the ETF that we've created. I know Ben and team is out there, and they're going to be talking about their Webb's proposition. He likes to use the thermostat, analogy. So nothing out there really. I like spiders, but I want to be able to control the volatility. There are new things out there, whether it's actively designed, rules-based, transparent management, or the fundamental active side of things coming out.
And we are just at time. Please join me in thanking this distinguished panel from this morning. Thank you.